There is a monster hiding in the global economy. It is $100 trillion in size. It is larger than the stock market. It is larger than the real estate market. 'Tis the foundation of every pension fund, every insurance policy, and every government budget on the planet. For 40 years, this monster was asleep. It was considered the safest, most boring asset class in existence. Financial advisors told you to put 40% of your portfolio into it to keep your money safe. Governments relied on it to fund their wars and their welfare programs. Banks used it as the pristine collateral that allowed them to lend money to you. But the monster has woken up, and it is angry. We are currently witnessing the beginning of the largest destruction of wealth in human history. It is not happening in the stock market, where everyone is looking. It is happening in the bond market, where almost no one is looking. This is the silent crash. It is silent because it does not show up on the evening news with red arrows and panicked traders on the floor of the New York Stock Exchange. It is silent because the math is complex and the consequences take time to ripple through the system. But make no mistake, the damage is already done. The losses are already locked in. And the mathematical reality is that the global bond market is mathematically guaranteed to lose value for years to come. To understand why this is a $100 trillion threat, you must first understand what a bond actually is. In its simplest form, a bond is a loan. When you buy a government bond, you are lending money to the government. In exchange, the government gives you an IOU. They promise to pay you back your original money in 10 years or 30 years. And in the meantime, they pay you a small amount of interest, known as the coupon. For the last 40 years, since 1981, interest rates have been falling. This is the single most important economic trend of our lifetimes. In 1981, the interest rate on a 10-year United States Treasury bond was nearly 16%. By 2020, it had fallen to nearly zero. This 40-year decline in rates created the greatest bull market in history for bonds. You see, bond prices and interest rates work like a seesaw. When interest rates go down, the price of existing bonds goes up. If you hold a bond paying 10% interest and new bonds are only paying 2%, your old bond is extremely valuable. Everyone wants it, so the price of your bond skyrockets. For 4 decades, bondholders looked like geniuses. They collected interest and the value of their bonds kept rising. It seemed like a magic money machine. It convinced the world that bonds were risk-free. It convinced banks that they could hold trillions of dollars in bonds as safe capital. It convinced governments that they could borrow infinite amounts of money because the cost of borrowing would always get cheaper. But then, in 2022, the seesaw broke. Inflation returned. When inflation rises, central banks have only one weapon to fight it. They must raise interest rates. And when interest rates rise, bond prices must fall. This is not a theory. It is a mathematical law. Imagine you bought a bond in 2020 that pays 1% interest. You paid $1,000 for it. Today, the government is issuing new bonds that pay 5% interest. Who would buy your old 1% bond for $1,000? No one. To sell it, you have to lower the price. You have to sell it for $800 or $700. You have just lost 30% of your money on an asset that was supposed to be safe. Now, multiply that loss by $100 trillion. This is the silent crash. The global bond market has lost nearly 20% of its value since its peak. That is roughly $30 trillion of wealth evaporated into thin air. That is equivalent to the entire GDP of the United States disappearing. But here's where the story gets terrifying. That $30 trillion was not just play money for day traders. It was the capital reserves of your bank. It was the solvency of your pension fund. It was the savings of your grandparents. Remember the collapse of Silicon Valley Bank in 2023? That was not caused by bad loans to tech startups. It was caused by the bond market crash. The bank had taken its depositors' money and put it into safe government bonds. When interest rates rose, the value of those bonds collapsed. When depositors asked for their money back, the bank had to sell the bonds at a loss, and they were instantly insolvent. Silicon Valley Bank was not an anomaly. It was a preview. Every bank in the Western world is sitting on unrealized losses in their bond portfolios. They are technically insolvent, but they are being allowed to pretend that the bonds are still worth their full value as long as they do not sell them. It is a massive accounting trick designed to prevent panic, but you cannot hide reality forever. The pressure is building, and the source of that pressure is the sheer volume of debt that governments are issuing. The United States government is currently running a deficit of nearly $2 trillion a year. That means they spend $2 trillion more than they collect in taxes. To fill that hole, they have to issue bonds. They have to find people to lend them $2 trillion every single year. But who has $2 trillion? For a long time, the buyers were price-insensitive entities. The Federal Reserve bought bonds with printed money. China bought bonds to manipulate its currency. Japan bought bonds. But today, those buyers are gone. The Federal Reserve is no longer buying bonds. It is selling them to fight inflation. China is selling bonds to defend its currency. Japan is selling bonds to save the yen. So we have a situation where the supply of bonds is exploding at the exact moment the biggest buyers are leaving the market. Economics 101 tells us what happens next. When supply goes up and demand goes down, the price must crash. And when bond prices crash, interest rates soar. This creates a doom loop for the government. As interest rates rise, the government has to pay more interest on its debt. Today, the United States government spends more on interest payments than it does on the entire military. Within a few years, interest will be the single largest item in the federal budget, costing more than Social Security. To pay that interest, the government has to borrow more money, which creates more bonds, which pushes interest rates higher, which increases the interest cost. It is a spiral of death. There is no mathematical way out of this loop without a crisis. Now, let us look at the story you know versus the story they hid. The story you know is that the economy is resilient. You hear that unemployment is low. You hear that the stock market is near all-time highs. You are told that the Federal Reserve has engineered a soft landing. The story they hid is that this stability is an illusion fueled by the last fumes of the bond bubble. The wealthy elites understood this shift years ago. While the average person was being told to buy safe bond funds, the ultra-wealthy were quietly exiting the bond market. They were buying farmland. They were buying gold. They were buying infrastructure. They were moving into assets that cannot be printed and that do not rely on a government promise. Look at the chart of gold prices versus bond prices over the last 5 years. It is a mirror image. Gold is breaking records while long-term bonds are crashing. This is the wealth transfer in action. The purchasing power is flowing from those who hold paper promises to those who hold hard assets. This transfer is not accidental, it is structural. During the Weimar Republic hyperinflation in 1923, there were people who became fabulously wealthy. They were not the people who saved money in the bank. The savers were wiped out. The people who got rich were the ones who borrowed huge amounts of depreciating currency to buy productive assets. Hugo Stinnes was the most famous example. He was a German industrialist who understood the math of the bond market crash before it happened. He borrowed massive amounts of German marks. He used that money to buy coal mines, steel mills, and shipping lines. When the currency collapsed and the bond market evaporated, his debts became worthless, but his assets retained their value. He effectively bought 20% of the German industry for free. We are seeing a modern, slower version of this dynamic today. Governments are inflating away their debt. They are choosing to destroy the value of the currency rather than default on their bonds. If you own a 30-year bond that pays 4% interest, but inflation is 5%, you are losing purchasing power every single year. You are the victim of the wealth transfer. You are subsidizing the government spending with your savings. The silent crash of the bond market is essentially a default by another name. A hard default is when the government says, "We cannot pay you back." A soft default is when the government pays you back, but the money they give you buys half as much as it used to. We are living through a slow-motion, soft default on $100 trillion of global debt. Why is no one talking about this? Because the entire financial industry is built on selling you bonds. Your 60-40 portfolio allocation, 60% stocks, 40% bonds, the bread and butter of the asset management industry. If they admitted that the 40% safe portion is actually a guaranteed loser, their business model would collapse. They have to keep selling you the narrative that bonds are insurance against a stock market crash. But in 2022, that insurance failed. Stocks fell and bonds fell at the same time. There was nowhere to hide. This correlation is the nightmare scenario for pension funds. Most pension funds assume they will earn a 7% annual return. They rely on bonds to provide a steady stream of income to pay retirees. If bonds are entering a multi-decade bear market, the math for pensions does not work. We're looking at a future where pension funds will have to cut benefits or demand massive taxpayer bailouts. So, what happens next? How does this silent crash resolve itself? There are only two paths forward, and both are painful. Path number 1. Fiscal austerity. Governments stop spending. They balance their budgets. They stop issuing new debt. This would stop the supply of bonds from growing, which would stabilize prices. However, this would cause a massive economic depression. The government would have to fire millions of workers, cut Social Security, and stop funding the military. No politician who wants to be re-elected will ever choose this path. Path number 2. Yield curve control. This is the path of least resistance. The central bank steps in and says, "We will not let interest rates rise any further." They commit to buying every bond that the market wants to sell at a fixed price. This saves the bond market from crashing, but it requires printing an infinite amount of money. If the Federal Reserve buys the bonds, they pay for them with newly created dollars. This floods the economy with cash, leading to high and persistent inflation. This is the trap. They can save the bond market, or they can save the currency. They cannot save both. Japan is currently trying to walk this tightrope. The Bank of Japan owns more than half of the entire Japanese bond market. They have printed yen to buy bonds to keep interest rates low. The result? The yen has crashed to multi-decade lows. The Japanese people are seeing their purchasing power destroyed to save the bond market. The United States is following the same playbook, just a few years behind. The silent crash is already changing the behavior of nations. Look at the BRICS alliance. Why are countries like China, Russia, India, and Brazil trying to trade outside the dollar system? Because they do not want to hold U.S. Treasury bonds anymore. They see the math. They see that holding U.S. debt is a guaranteed way to lose wealth. They are opting out of the Western bond market. This reduces the demand for Western debt even further, accelerating the crash. It is important to realize that crash in the bond market does not always mean a sudden drop in one day. It can look like a slow, grinding bleed that lasts for 10 or 20 years. It is a loss of altitude that never recovers. Imagine you are a retiree. You have saved $1 million. You put it in bonds to be safe. You expect to live off the $40,000 a year in interest, but inflation is running at 5%. Your grocery bill, your property taxes, and your medical costs are going up. The $40,000 buys less and less. And the principal value of your $1 million is dropping because rates are staying high. You are becoming poorer every day, even though you saved money. This is the tragedy of the silent crash. It punishes the prudent. It punishes the savers. And it rewards the gamblers and the debtors. So, what can you do? First, you must recognize that the old rules of investing are dead. The idea that bonds are risk-free is a relic of a bygone era. In a world of high debt and high inflation, bonds are return-free risk. Second, you need to understand the concept of real assets. A bond is a claim on future currency. A real asset is a claim on something tangible. Real estate, commodities, precious metals, productive businesses, these are things that have intrinsic value regardless of what the currency does. Third, you must watch the yield curve. When short-term interest rates are higher than long-term interest rates in an inverted yield curve, it is a warning signal. It means the market is broken. It usually precedes a recession. But this time, the recession might not bring lower rates because inflation is sticky. We could enter a period of stagflation, stagnant growth, and high inflation. In that environment, stocks can struggle and bonds can get crushed simultaneously. The silent crash is the story of the unraveling of the post-World War II financial order. That order was built on the dominance of the U.S. Treasury bond as the global reserve asset. As that asset loses its reliability, the entire system becomes unstable. We are moving from a unipolar financial world to a multipolar one. Capital is confused. It is looking for a new home, and volatility is the price of this transition. Do not let the silence of this crash fool you. Just because CNN is running a crisis in the bond market banner every hour, doesn't mean your wealth is in danger. The most dangerous threats are the ones you do not see until it is too late. The $100 trillion bubble is leaking. The air is coming out, and the central banks are running out of patches. If this analysis has opened your eyes to the reality of the bond market, consider subscribing. We are dedicated to tracking the signals that the mainstream media ignores. We follow the liquidity, we follow the debt, and we follow the real story of wealth transfer. In our next video, we will be diving deep into the shadow banking system, the unregulated network of lenders that is hiding trillions of dollars of risk completely off the books, and why a bond market crash could trigger a margin call that wipes them out overnight. You need to be prepared for that.